us for the quarterly market review in the second quarter of 2016. I'm Deborah Brennan-Tagg, and I will be taking you through what is happening in today's markets in the U.S. and across the globe. As you probably already know, I am a certified financial planner, and I'm also an investment advisor, so it is important for you to know that our work is focused on risk and return. So we're really trying to help our clients achieve their financial goals. We are not the sort of practice that is shooting for the moon or looking to uncover opportunities that you would talk about at cocktail parties. We are much more about consistency, and these days my focus is completely on risk and not so much on shooting for traditional returns like we've had in the market, and I'll walk you through what all that looks like. As we walk through the quarterly market review today, we'll go through a market summary and look at world stock market performance, world asset classes, U.S. stocks, international and developed stocks, look a little bit at emerging market stocks and select country performance and what has contributed to the recent rise in that area. We'll look at the really tremendous returns of real estate investment trusts and commodities, how they've had a roaring comeback this year. Some interesting numbers that we'll be looking at in fixed income and what the results have been of a globally diversified portfolio. We'll also touch a bit at the end on the GDP growth in the U.S. and the GDP expectations across the globe and how they play into equity returns. So before we waste any time with anything, I'm going to go ahead and just look directly at the market summary. Now, if I had talked to you in the first part of this year, I would have said these kinds of numbers are not what we would be expecting in the second quarter. And of course, the market has had great returns even beyond the second quarter. At the beginning of the year, I was definitely telling clients this is going to be a shaky year with lots of volatility, and I still believe that we will have the same kinds of results for this year. I think that volatility is just built into what we have going on in our markets right now. But we had some great returns. So we saw that the U.S. stock market was positive. We saw the only negative that we had for the quarter was international developed stocks. We have a lot to talk about on that today. Emerging markets were up. They've had a great run up lately. And then global real estate logging another great quarter at 4.48%. The U.S. bond market surprised us as well as the global bond market with returns of 2.21% and 3.11% respectively. A couple things I want to show you on this slide too is to look at the average quarterly returns, the best quarter and the worst quarter, which is on the bottom half of the page. So if we look at the worst quarter, look all the way over on the right-hand side to the bond markets. The worst quarters that they had were negative 2.4% and negative 3.2%. Now let's back it up a little bit to the left and look at the worst quarters, the negative returns under the U.S. stock market, negative 22.8%, international developed markets, negative 21.2%, emerging market stocks, negative 27.6%, and global real estate back in 2008, negative 36%. So obviously, a quarter return with that kind of a downturn is something that is fairly scary and is still in the minds of investors quite a bit. And so we need to remember that those kinds of downturns are possible, but certainly the average quarterly return has been consistent, and then the best quarters, if you look above that, have seen some great numbers, and they were all consistently in the second quarter of 2009 when we saw that roaring comeback after 2008. So one of the things that I'm really focusing on with my clients is their risk, and we have always focused on that, but considering that returns are not as high right now in the market as they traditionally have been, we want to make sure that we are not overreaching on risk to try to provide some sort of a return that we were used to at some point. Certainly, my job is not to make sure that people are in the stock market. My job is to make sure that they are appropriately diversified according to what their goals are and how much risk they can handle. So it is important for us to look at both the best quarter and the worst quarter so that we know what we have as far as parameters. And then also when we look at the bond market, which is more of a steady Eddie performance, at least historically, we see that we can do some investing that doesn't have to be high risk. And so that really is one of our focuses right now and will continue to be our focus moving forward. Looking at the world stock market performance, we had quite an exciting quarter. So there are a couple of things that we want to see here, take a look at, and the most important things are that there's a lot of conflicting information in the market right now, and there's very little leadership. I'm sad to say that the Fed is not providing us great leadership right now. So if you look on the bottom in the gray box area on the left-hand side, you'll see that the Fed signals no rush to raise rates. And then you'll see a little bit further over on the right-hand side, weak hiring pushes back the Fed's plans. It has been a real disappointment that the Fed has not been able to put a policy in place that anybody can really count on. There was great expectation going into 2016 that we would have between 2 and 4 Fed funds rate hikes this year. I was not a believer in that because I've watched this Fed for a long time, and I thought that they would not be interested in raising rates given what I expected of the economy. And sure enough, that's been the case. So the Fed has been very reluctant. Many of their comments have been about the uncertainty in the market, not only our market, but the global markets. Also uncertainty around jobless claims and what direction that's going. So we saw with the weak hiring that was an easy way, that was an easy out for them. So that was an easy time for them to say, you know what, we're actually just going to hold steady right now, and we're going to back off our plans to increase rates. The market took that very favorably, and our stock market has actually had great performance since then, aside from the Brexit vote, which we'll talk about in just a minute. The Federal Reserve did meet again yesterday, and they talked again about the uncertainty in the market. They said that some of the concerns that they had were off the table. They did not indicate that they would be increasing later this year, and in fact, most people are now saying that there's not going to be an increase until 2017, which was what we expected coming into 2016. What that means for investors is that it supports the stock market for a little while longer. It means that the mortgage rates are going to remain low. It also means, unfortunately, that savings rates are going to remain low at the banks. And so the stance that we have had with the Fed and all things that are interest rate related will remain just about the same. Let's look far over on the right-hand side where it says the Brexit vote pushes Britain into uncharted waters. I can tell you that when we went home the night before the Brexit vote, I said, no worries, everybody. They are not going to vote to leave. I'll see you tomorrow. We don't even have to think about it. And I was sure surprised when we woke up in the morning and found out that they had voted to leave. And it's not so much the effect that all of that is going to have on our economy. It's not at all that Britain is a big manufacturing and export source. It's not that they're a huge trading partner of ours. Really, it just creates a whole lot of uncertainty. And so the market was really gearing up to have some certainty around the vote. So just having the vote over and done with is certainty for the market. And unfortunately, because they voted to Brexit, they sent the whole market, especially the EU, into very uncertain territory. And unfortunately, that territory is not going to be any more clear probably for at least another 2 years. Immediately, the two leaders that had really led the Brexit movement bowed out, and so there was no leadership. There was no plan, which seems to be a global phenomenon these days. So no leadership, no plan, and it really caused a lot of concerns about what's going to be going on with the future of the EU and certainly of Britain. They now have a new prime minister. She seems very focused on getting things under control and having them happen in an orderly way, which is quite like the English people. So we would assume something like that is going to happen, but she still has a whole lot of work ahead of her, as does the country. And the EU has to figure out exactly what the trade agreements are going to look like. So there's just a lot of uncertainty over there. We have uncertainty throughout a lot of the international economies, and we'll talk through at the end what that means to our allocations. So if you remember at the beginning of the year, we had the worst start to the year ever that we've seen in the U.S. stock market, and now we had a great rebound on the far right-hand side. You see the deep V right after the Brexit. We saw the market go down a little bit. It really did not go down either as deeply or as long as we anticipated that it would once we knew that Brexit was the way that the vote turned out. In the end, it bounced right back up, and we have set new highs since then. Moving on to what it looks like over the last 12 months. So again, the whole conflict, the different data coming at us, having different responses depending on what time of year we're looking at it. So on the left-hand side, U.S. oil prices fall to a 6-year low. That was actually back in the fall of last year. And then on the right-hand side at the bottom, oil prices rebound and leave investors guessing what's next. And that probably is a good summation of what's happening in many different markets right now. The oil prices went down in the 20s in January, and there was a lot of concern that the wheels were just coming off and that the train was going off the track, and oh my gosh, should we go to cash, and should we get out of the market, and should we pull money out of the stock funds? We did not do anything like that. We stayed the course. We knew that we were well allocated as far as risk in our portfolios. So we stayed the course, and that has certainly been the right choice in hindsight, and it's good to see that. It is proof to us that the economy is in a stable place. So I wouldn't say that we're in a growth trajectory, but we are in a stable place right now. And that tells us that being in balanced funds is a good place for us to be right now, or in balanced allocations. We don't anticipate that we are going to have to pull money off the table, get very conservative, but we are certainly not getting any more aggressive than we feel like is appropriate at this point in time, mainly because of what we are seeing across the markets. If you look also in the middle, you'll see European markets to finish 2015 among the world's top performers. Well, obviously, since Brexit, all of that story has changed. They're looking for a negative GDP in Britain over the next year or two, and possibly longer than that, and there's not really a clear understanding of what that will do to the European markets. On the right-hand side, you'll see Eurozone slides back into deflation. So certainly a lot of mixed reports coming out of Europe. You'll also see back over on the left third of the page, the IMF downgrades the global economic outlook again. So we have seen this consistently since last year. The IMF, the International Monetary Fund, looks top down basically at the globe to figure out where's the growth going to come from, and are we in a forward moving pattern, or are we sliding into either deflation or recession or any of those things, which will be tough across the globe. Right now, the global outlook for 2016 is 3.1% on GDP. The projection from the IMF in 2017 is 3.4%. Both of those numbers were recently downgraded by 0.1%. 0.1% is not a big number, but the point is that we've seen these little minor downgrades over and over again. So certainly what growth we thought that we were going to see a year ago, we're not quite on pace with that. The good news in the 3.1% number and the 3.4% number is that they are consistent and they are positive. And so a 3% consistent number really is okay. In 2014, the world output was 3.4%. In 2015, it was 3.1%. So stable economies, given how many other things seem unstable right now, stable economies across the globe are actually great news. So even though we've seen these little minor downgrades from the IMF, it really doesn't give me any concern. We would be concerned if they had either a significant downgrade, or quite frankly, if we got into a sudden growth pattern, we would want to know where that came from and if there's going to be a correction after that. So the slow and steady wins the race kind of a mood that the global economies are in is actually okay for right now, and it is not an indication of any sort of a weakness. So next, let's look at the world asset classes. Once again, the Select REIT Index is leading the pack. We saw some great returns actually from the Russell 1000, Russell 2000. One of the things that you'll see consistently as we go through these numbers is right now, at least in U.S. stocks, value is leading growth. That's not always the case. That was not the case at the end of last year. Growth was leading value somewhat. And so again, more reasons for us to be diversified. It is difficult to figure out which one of those is going to lead in any given year, so we want to have allocations in both of them, but certainly value in large, mid, and small cap has led on both sides. You will see on the bottom left that we did have some negative numbers, and they are international, and that has been one of the issues with the portfolios is the drag that international has provided, and so we are actually going to be reducing our allocations to international holdings. We started that process a few months ago. We continue to implement that. So we are either reducing or eliminating our allocation international right now with the outlook that we're seeing from the Brexit results, and then also what is happening with Japan right now. First, we'll talk more about U.S. stocks. So here are the numbers that we see for the second quarter returns. Again, this is just one quarter. So the large cap value number is 4.58% in just the second quarter. And we can contrast that with the large cap growth return, which was 0.61%. So that's a pretty big spread between large cap value and large cap growth. We saw really good numbers from small cap as well, so good consistency across the board. So our year-to-date numbers are strong and positive. Small cap growth is still slightly negative. It had a really rough year over the past year. The one-year return for small cap growth is still at negative 10.75%, so that takes a bit of recovery to get back on track with that. Looking at the 3, 5, and 10 years for U.S. stocks, if we look at large cap, those numbers are really, really consistent. So yeah, if we look at market-wide, it's 11.13%, 5 years 11.6%, 10 years 7.4%. Nobody really invests just in stocks, or it's not the wise thing to do traditionally. Having a globally diversified portfolio is better for risk and return in many markets, and obviously we want to have everybody adjusted to the right amount of risk according to what their goals are and how much risk they can really just handle on a day-to-day basis. So think about these numbers and keep them in the back of your mind when we go on to the globally diversified portfolios, and we'll look at the returns there and how having the international in the portfolios has actually not been a positive contributor in markets across the board. So now look at international developed stocks. We are reducing our allocation here, and so the year-to-date numbers are all negative: large cap, small cap, value, and growth. The one-year numbers are all negative, and they're fairly negative. The negative numbers on large cap, negative 9.84%. Small cap, negative 3.35%, value, negative 14.35%, and growth, negative 5.25%. So when we mix the international developed stocks, which we have held in the portfolios, in with the U.S. stocks, those big negative numbers are going to draw down the total portfolio returns. And so in looking at those and in looking forward at where we want to put our clients' money and to hold the money, and where we want to have exposure, and where we think we have good policies and stability, the U.S. really, in my opinion, is much stronger than the international developed markets that we would look to. We have already talked about Brexit and the results that it will have over in Britain, and how they'll probably have negative GDP over there for the next few years. We are anticipating that the EU will continue to struggle, so other major economies over there, including Germany and France and Italy, they just are going to have a lot of challenges, not just because of Brexit, but because of the immigration issues that they have right now. So they just have a lot of unusual economic issues right now that they just simply have to work through. The other issue to talk about, though, is negative interest rate policy, which has crept up in countries around the world. And I've talked to many, many clients about this. I don't know how to say it any other way. I just think it's the craziest thing I've ever heard of. So there are negative interest rates in a number of countries. Japan has negative interest rates right now. Switzerland has negative interest rates all the way out from their one-year bond all the way out to their 30-year bond. Japan has negative interest rates on their 1 year all the way out to their 15-year. Germany has negative interest rates from their 1 year all the way out to their 15-year. And then we also see negative interest rates in Belgium, Austria, France, Ireland, Italy, and Spain. For me, it's sort of like telling me 1 + 1 no longer equals 2. I think that the experiment with negative interest rates is just something where we simply don't know how it's going to work out. It is really hard to understand how it was even ever implemented. I will be very surprised if we ever see anything like that in the U.S. I can't imagine that we would go that direction. The other important thing to understand is that as these interest rates go negative in these other countries, a negative interest rate is an indication, well, any interest rate is an indication of the strength of the economy. So it's a forward-looking indicator as far as what we think the strength of the economy is and future growth. So if we are looking at any of these countries and seeing a negative interest rate, then what we are saying is they are not likely to produce growth. The U.S., on the other hand, does have positive, slightly positive, but positive interest rates on our debt, on our U.S. Treasuries. And so that says that there is at least some growth that we would expect in the U.S. And certainly the U.S. is still the darling of the entire globe right now when it comes to economies and future strength. And I know that sometimes with all the things that we hear from the media, it doesn't feel like that at home. But when we look at what's happening with flows and where money is going, we are seeing lots and lots of money come into the U.S. And the reason is because of these concerns around the rest of the world. So certainly we think that that will benefit our economy. It will benefit our stock markets, and it is very likely to benefit our bond markets as well. So I don't see a reason, as long as we have money flowing our direction, I don't see a reason that we would even think that it's a good idea to go into negative interest rates. So we don't believe that that's something that's on the table for the U.S. It is still definitely a concern for what we're seeing in other countries. Therefore, when we look at international developed stocks, there really are not many other regions of the world that I would rather invest in at this point especially given these recent bits of information that we have found out that we would want to look at going forward. So again, our reduction in international is because of all of those issues that have developed. When we look at emerging market stocks, we had made a decision when China devalued their currency last August that it was just going to create too much concern, uncertainty, and volatility in the emerging market stocks. So we pulled out of emerging markets at that point in time. I don't regret that. I will not regret that. I have no intention of coming back into emerging market stocks, mostly because of the volatility. If we look at the year-to-date numbers, they are strong, they are solid, but if you look at the 1-year, 3-year, and 5-year numbers, they are almost all negative. And if we look at the 1-year numbers, they're down significantly. So on the large cap, negative 12.05%, small cap, negative 12.76%. Value is down 14.41%, and growth is down 9.83%. Those are big enough numbers, but a 1-year downturn you can recover from. When we look back at 3 and 5 years and see that those are still negative numbers, and it's only when we stretch all the way out to 10 years that we see a positive return of only 3%, I don't get excited about bringing that kind of risk and volatility into my clients' portfolios, especially given the kinds of clients that we have. So we don't intend to come back into emerging market stocks anytime in the near future. If we do look at what's happening on a country-to-country, country-by-country basis, we have developed markets on the left-hand side. We have ranked emerging markets on the right-hand side. So we did see some strong numbers there, but if you see on the right-hand side in emerging markets, Peru and Brazil were the 2 big winners. That obviously is not a place where we're going to concentrate any of our clients' funds. And then if you look all the way at the bottom, Poland and Greece had negative numbers that were nearly as big as Peru and Brazil. So again, wild volatility and differences in returns depending on which country people were invested in. For us, the developed markets are the way to go. U.S. is the 4th down, so New Zealand, Canada, and Norway actually had better quarters than we did. But of course, they're international, so we'll just be reducing our allocation international across the board. When we look at real estate investment trust, this is a measurement of the Dow Jones U.S. Select REIT Index, and the numbers are very, very strong here. I would encourage anyone who is looking at this to really understand that REITs come in all different shapes and sizes. And so if you are looking at REITs and thinking, well, real estate's a great place to invest, there are all sorts of different segments of the real estate market, and I would want to make sure that you are really educated on what you're investing in before you get into anything that is real estate. Real estate is definitely one of those things that should be a long-term investment. You should have a long-term investment horizon if you are going into real estate of any sort, even if it is a liquid REIT. But the year-to-date numbers so far, 10.82% on U.S. REITs and 10.02% on global REITs. We've had some difference in those returns over the last few years, so to see them going neck and neck is actually really interesting. On the 1-year return on the U.S. REITs, 22.85%, and on the global REITs, 7.25%. Interesting to note here is that we have really strong consistent numbers on year-to-date, 1 year, 3 year, 5 years. 10-year, it drops off by about half, so the 10-year number is 6.86% on the U.S. REITs and 3.31 on the global REITs, and that's because we mix in the 2008 downturn. However, if we think about what that 2008 downturn was, the downturn was somewhere between 30 and 40% in 2008. So factoring in a number that was that big of a spike down, those are still consistent and strong numbers on a 10-year basis. We are layering in more real estate into our clients' portfolios this year, and we do that in a variety of ways, and we certainly do that on a client-specific basis, but that is one of the goals that we have this year. While we're reducing international, we are also increasing our real estate exposure. Commodities have had a really interesting time lately. You see these huge numbers on natural gas, on sugar, on soybeans at 30.88%, 29.84%. Huge numbers just for 1 quarter, but the volatility is just massive in commodities, and I anticipate that it will continue to be that way going forward. If you look at the period returns, the year-to-date number is 13.25%, but all negative on 1, 3, 5, and 10 years. So negative 13.32% on 1 year, negative 5.59% on 10 years. We steer clear of commodities in general in the portfolios. There's a little bit of commodity exposure in some of our clients' portfolios simply by other investments that are present in their portfolio, but we do not do commodity specific investing. You will see in here also gold. So if you look about a third of the way down or 2/3 of the way down on the list, gold had a return of 6.67%. I don't generally invest in gold. I don't anticipate adding gold to the portfolios at any time in the near future, but gold is being discussed right now as a diversifier, not holding gold bars, but actually just having gold in the portfolio. So we get conversations with clients a lot about gold and do we believe in gold. Gold is a commodity and has a whole lot of volatility about it, and it is a diversifier, but it also corrects as quickly as any other commodity. So I generally don't like to have gold in the portfolios because of how quickly it tends to correct once things get rosier. So gold is one of those things that people like to go into when everything sounds terrible and the financial markets seem to be falling apart and who knows what's going on in the world. That's really when people like gold. And then as soon as the sentiment goes strong again, especially in the stock market, then gold generally has a reaction to reduce its value, and it usually happens so quickly that it's hard to get out of it before all of that happens. So I still am not excited about adding gold to the portfolios, but we certainly do look at it as a tool that we can add in if we feel like the time is right. Moving on to fixed income. So fixed income generally is referring to bonds. Fixed income also includes cash, but that is not on here. And of course, the cash returns have been paltry at best. So we do have some surprises on here. If you look in the period returns on the bottom right-hand side, if you look at the Barclays Long U.S. Government Bond Index, year-to-date number is 14.94%, which is just a shock. But then you look across and you say, well, 1 year is 18.98%, 3 years is 10.38%, 5 years is 10.17%, and 10 years is 8.69%. One of the most interesting things that has happened in our industry is that people have been talking about how the bond market is going to fall apart since 2009. So as soon as we had the recovery out of 2008, everybody said, oh my gosh, the Fed brought the interest rates down to 0. It's going to create massive inflation. It's going to tank the bond market. Then the Fed intervened. They started their different quantitative easing programs, and everybody said, oh my gosh, it's going to be terrible when they stop the quantitative easing programs. It's going to tank the bond market. Then that worked out just fine. And then the stock market was going up, and everyone said, oh my gosh, the stock market's going to go up so much that people are going to pull out of bonds and it's going to tank the bond market. What is happening with bonds is that the more uncertainty that is in the world, the more people like U.S. government bonds. And that may be the one thing that has been consistent over the last 10 years. There are many, many things that are sort of in the traditional textbook of if this happens, then this should happen in financial markets that have kind of been thrown out the window, mostly because of quantitative easing and central bank policies around the globe. But the one thing that has been consistent is that people really like U.S. government bonds. We have a great big military, we have a fairly stable economy, and despite what's going on in the elections, we actually have a really good political process. So this has been very interesting. Everybody keeps saying that the U.S. government bond market is just about to fall apart. There are lots of people who are saying it now, that that is the one place that they would avoid, and I just look at this sort of a consistency, and I wonder how long it can last for sure, but we also certainly don't count this out as a piece of our allocation. Bonds really have surprised everybody across the board. I would say the U.S. Aggregate Bond Index also has a strong year-to-date number at 5.31%. The U.S. Corporate High Yield Index comes in at 9.06% year-to-date. It is not an area that I'm focusing on right now. So corporate high yield means that they're paying you more money on that bond. It has a higher yield. They're paying you more money. The reason they're paying you more money is because there's higher risk. And again, my focus right now is about lowering risk in the portfolios. So even though that has done very well, that has not been an area that we have focused on at all. The Barclays Municipal Bond Index, I also want to bring your attention to that. So the year-to-date return is 4.33%. We would assume that an entire year's return would be around 4.33%. So the fact that it's already at 4.33 may mean that we are leveling off between now and the end of the year, or we may still have some room to grow. So the 1 year return there is 7.6%. 3.65%, very high for municipal bonds traditionally. But if you look at the 3, 5, and 10-year numbers, they're very consistent at 5 to 5.5%. So we really like the municipal bond market as well. So for all of the discussion that there consistently has been for years now about how the bond markets are going to fall apart and bond investors are just going to lose all their money and interest rates are going to go up and bond markets are going to crash and all of that, we just don't believe in it. We believe that this is a different paradigm that we're in because of the central banks around the world and what they've done to manipulate the markets. It's actually, in a very strange way, has created a lot of around the bond market because universally we see low interest rates. And so we don't have competition from Germany or England or Japan for higher interest rates. Everybody is at very low, or as we talked about earlier, negative interest rates, which actually gives us some stability. So we will continue to have exposure to all of the bond classes that we have held traditionally. We are obviously always looking for places that we could have any kind of an issue unexpectedly, but we are certainly pleased with our bond allocations at this point. So let's look at global diversification, bringing the whole thing together, and we talked about this on the last quarterly call as well. So if we look at the period returns on the left-hand side, that really tells us the story. If you look, the easiest thing to look at is a 50-50 asset class, so that's 50% in equities and 50% in fixed income, and that would include a combination of U.S. and international. So the year-to-date there is only 0.95%. The 1 year is actually still negative. The 3-year return is 3.45%. The 5 years is 3.19%, and the 10-year is at 3.23%. And so if we look up at a 75, 25, 75% equity, 25% bonds, the numbers are a little bit better, but they're not significantly better. So we still see that the tried and true adage that if you have more stock in your portfolio, the long-term performance is going to be better than if you don't have stock, as high a percentage of stocks in your portfolio. We still see that consistently throughout the different time frames. Nonetheless, most people do have a diversified portfolio. And in my opinion, that still is the right thing to do. I don't look at any of these historic numbers and say, well, gosh, we should all just be in large cap value, U.S. large cap value. That seems to be doing the best. If you had everything in U.S. large cap value, you probably would not experience the returns of an index, because an index never comes out of the market. And what happens when we have people that have very high stock allocations, they tend to get nervous about the market as it bounces around and has lots of volatility, especially like we saw at the beginning of the year. And investors who are invested with all of that risk tend to overreact in the market, tend to be emotional, and tend to pull out just at the time that they shouldn't be pulling out. And so really what we want to do is we want to keep you with consistent returns, we want to lower your risk, and we want to give you a good return for the amount of risk that you have in your portfolio. I do believe that we have a lot of risk in the markets right now simply because there's so many unknowns. So by saying that I believe that there's a lot of risk, that doesn't mean that I believe that the stock market is going to go into some great collapse. In fact, I don't believe that at all. But what I do believe is that we just have a lot of unknowns. And so there will be things that feel maybe a little scarier than they actually are. For example, when oil went down in the 20s earlier this year, it really wasn't an indicator of anything having to do with the economy or the stock market. But there was a massive overreaction in our industry and certainly in financial markets around the world about that. And then there was a pretty quick recovery about it. And so we just want to make sure that we don't overreact to short-term events. Certainly my job is to make sure that if we have long-term events brewing, that we are taking the proper steps to be able to either get on the sidelines during a time like that or to talk to our clients about how much risk we see in portfolios. I had at one point in time hoped that we would have a president elected in November that would be a really strong leader that the country could get behind, and currently I don't have that hope right now. But nonetheless, it will be one more thing that will be behind us. So after November, we will have some more uncertainty taken out of the market, and we will assume that we will at least start to see the direction that things are going to go in. Our two candidates right now are so completely opposite that we should be able to forecast what taxes are going to look like, what companies are going to think about that, how individuals are going to react, and we will certainly have stronger opinions about 2017 once we see the election. One more point I want to wrap up on also is the relationship between GDP growth and equity returns. So this feeds back into what I was just talking about where the economy is going and then what we believe is going to happen with the stock market. So we did see some concern from clients after the U.S. GDP growth was estimated at 0.5% in the first quarter of 2016. We actually see that somewhat often in the first quarter because there are some weather patterns that can cause economic activity to go down. Many times these estimates are revised later once they're able to crunch all of the numbers and see what the actual economic activity was. And so that is very, very far below the historical average of 3.2%. However, we don't believe that that means that that's what the full year is going to look like. So we don't really have concerns about that. There are some numbers here about what the average quarterly returns have been all the way back from 1948 to 2016. During that time period, which is a very, very long time period, the all-quarter return was 3.0%. And the return in the S&P 500 after a bottom quartile GDP growth was actually 3.2%. So there is not a direct correlation or an immediate correlation between a lower GDP and the stock market falling off. Absolutely, the two are connected to each other. They have been more divergent lately because the economy has not recovered as much as the stock market did between 2013 and 14. So right now, in my opinion, there's not as strong a relationship between the stock market and the economy as there used to be, but absolutely one feeds into the other, and the stock market is supposed to be at least a fully disclosed reading of the earnings that we are seeing, the price to earnings ratio of U.S. companies, and U.S. companies are a huge part of our GDP. So we're not ignoring that the two of them work together, but we also don't want to look at one quarter of GDP and have any kind of an estimate of what that would mean in the U.S. stock market. I did tell people earlier this year that as soon as everybody in my industry agrees on one thing, the market usually goes the other direction, and that is exactly what has happened so far. So everybody that I know, whether they were bulls or bears or whatever their traditional point of view was, everybody agreed that we were not going to have great returns this year, that a balanced portfolio might be able to achieve a 5% rate of return, and that has been our target for 2016. And then we just set all-time highs in the stock market. So that's one of the reasons that we don't want to unnecessarily come out of the markets and go onto the sidelines, even though we have a higher level of risk. The stock market gives us surprises no matter how long we do this. And so we do have to understand that we just are in a different time right now. We anticipate that the market returns are going to be lower for the next 1 to 2 years. But what happens sometimes when we get a new administration in is that they put new policies in place, and those policies can be good for the economy, and that usually takes about 18 to 24 months to implement. So we do see that there is hope ahead of us, depending, of course, on who is elected and how all of those plans play out. But we do definitely have hope for the future, and we will keep you tuned into what our thoughts are, especially after the election. Don't watch your television too much. It's probably bad for all of us these days. Go out and enjoy the summer and enjoy your family. We really appreciate you being a part of our family. If you have any questions, certainly give me or any of the team members a call, and we'll be happy to help you. Thank you so much for joining us today.